my first read, it looks like a big beat for Lloyd Blankfein at Goldman Sachs. First quarter earnings per share coming in at $5.94. FICC revenue trading up to $3.13 billion, well ahead of estimates for $2.92 billion. Lucky us, we have an expert on set. Scarfu, what are you seeing?
Well, we're looking at FICC revenue, and that's a number that everyone's so fixated on. $3.13 billion in revenue. The consensus among analysts was for an increase to $2.92 billion, but this is better than anticipated, topping that $3 billion mark. Equities revenue also increasing as well, $2.33 billion when analysts were looking for $1.74 billion. So Goldman Sachs giving us a report that really supports JP Morgan's increase in first quarter trading as well. Looking through some of the other numbers, investment management revenue of $1.58 billion, also topping the consensus. But this gives you a sense of how much bigger a deal trading is than the other businesses. When FICC is $3.13 billion, and let's say investment lending, which includes Goldman Sachs' own holdings, is $1.43 billion. This is a bank that's leveraged completely on its trading operations.
And also following in JP Morgan's footsteps and boosting the dividend here, Goldman Sachs boosting its quarterly dividend to 65 cents. Also saying, Scarlet, that the compensation ratio in the first quarter is now 42%. Operating expenses up 6%. But overall, a huge beat.
It's interesting.
$5.94 versus $4.25.
And I wonder if we're comparing like with like. We'd have to go through some of the numbers to see if there's a charge in there or credit in there from accounting adjustments. But that 42% comp ratio is interesting because Jason Goldberg of Barclays has pointed out that what Goldman Sachs typically does is put aside a lot of money in the first half of the year and then really reduce the amount of money it sets aside in the second half to keep that cap overall at about 44%. We'll see how it plays out the rest of the year. You mentioned the dividend. That was something we expected following the stress test results. What we want to find out now is how much money, how much in shares Goldman plans to buy back. Because you remember, they were extra aggressive in asking the Federal Reserve for permission to return cash.
You know, Brendan, it's interesting. Shares are barely moving in the pre-market, though. They closed yesterday at 201, so the first time Goldman Sachs shares have closed above $200 since 2008. Right now, in early trading, they're up to about 204. With such a big beat, I would have almost expected a bigger pop.
You know, Josh Wright is here with us from Bloomberg Intelligence. You know, if you look at these results of the gimlet eye of a regulator, what I'm seeing here is a common equity tier 1 ratio, according to Basel III, is 12.6%. That is well above what Bank of America reported yesterday, 10.3%. The same measure. Do you see banks being more cautious now?
Well, certainly they're being made to be more cautious. But I think if I were a regulator, and to be clear, I never was a regulator or a bank examiner myself, but I'd want to know, where is this pop in revenue in trading coming from? Looks like some of the volatility in the dollar and oil and these shifts in these cross currents with global central banks, that's got to be good for trading, I would think. Years ago, people were complaining that things weren't volatile enough. But volatility and lack of volatility is a two-sided knife, and it looks like they're benefiting.
Trading revenue coming back, again, investment banking back, but FICC really a big boost. And Scar, it looks from the Bloomberg headlines like it is apples for apples, $5.94 versus estimates of $4.
That is a pretty incredible beat.
Huge morning over at Goldman Sachs.